Is Bilt 2.0 worth it in 2026? The real cost versus rewards. A quick note before we continue. Ads may play during this video. Your support keeps this content free. Now let's jump in. If you're wondering whether the Bilt Mastercard's recent restructuring actually delivers value for high net worth individuals and business owners, this video breaks down the real economics, the opportunity cost of points programs, the hidden liability implications of rent-based credit strategies, and whether this card genuinely optimizes your capital allocation framework. By the end of this analysis, you'll understand the precise cost basis of each point you earn, how rent payments affect your credit utilization for future financing, whether the transfer partners actually provide institutional-grade value, and how this card fits within a sophisticated personal balance sheet strategy. Before we end, I will summarize the vital and critical information, including 4 critical insights that will fundamentally change how you evaluate reward optimization against actual wealth preservation. You'll want to grab a pen because what I'm sharing is the capital efficiency framework that wealth advisory firms typically charge $1,500 to $3,000 to explain in private consultations, and 90% of cardholders completely misunderstand the true cost of rewards programs when measured against alternative capital deployment. Let's begin with what I call the true cost calculation framework. The Bilt card offers 1 point per dollar on rent payments without transaction fees. But here's what most analysts miss. When you pay $5,000 monthly in rent to earn 5,000 points, you're not earning free value. You're converting liquid capital into a liquid loyalty currency with redemption restrictions, expiration risks, and valuation volatility. If you're a business owner with access to capital earning 4 to 6% annually, you're generating a maximum 2% return through points while potentially sacrificing 4 to 6% elsewhere. The opportunity cost isn't just real. It's the difference between wealth preservation and wealth erosion. Most cardholders never calculate the embedded cost basis of their points. The points you earn today might be worth 2 cents each for airline transfers, but historically, loyalty programs devalue their currencies by 15 to 30% every 3 to 5 years through program changes or partner modifications. This brings us to the liquidity versus illiquidity trade. Every dollar you convert into points loses immediate liquidity. You cannot use those points to meet margin calls, capitalize on investment opportunities, or manage unexpected business expenses. When you hold 50,000 Bilt points instead of $1,000 in accessible capital, you've traded flexibility for a promise of future value. And that promise comes with counterparty risk and opportunity cost. If you maintain a taxable investment portfolio earning 8 to 12% annually, every dollar allocated toward rent payments that could have been invested represents foregone compound growth. Over 10 years, the difference between earning 2% through points and 8% through index funds on $5,000 monthly is approximately $470,000 in opportunity cost, far exceeding any potential rewards earnings. Now let's discuss credit utilization architecture. If you're paying $4,000 to $8,000 monthly in rent on this card with a $25,000 credit limit, you're running 16 to 32% utilization even if you pay in full. For individuals seeking significant financing, business lines of credit, commercial real estate loans, or portfolio margin accounts, lenders evaluate your credit utilization across all open accounts. Higher utilization can result in higher borrowing costs or reduced credit limits elsewhere. This is where entity structuring becomes critical, because when you run large rent payments through a personal credit card, You're potentially constraining your personal credit profile when that capacity might be more valuable for emergency liquidity or rate negotiations on other credit facilities. Here's where we need institutional precision with rewards valuation methodology. Bilt points transfer to approximately 15 airline and hotel partners, but theoretical value assumes optimal redemptions for premium cabin international flights or peak season luxury hotels. Most redemptions occur at substantially lower values. When I analyze rewards programs for clients, I use expected value calculation, not best-case scenarios. If 70% of your redemptions occur at 1 to 1.2 cents per point, your actual expected value is approximately 1.3 cents per point. On 5,000 USD monthly rent, that's 65 USD in monthly value, or 780 USD annually. Compare that to investing that capital at 8% annual return, which generates approximately 5,000 USD in the first year alone, 6 times the rewards value. The partnership ecosystem analysis reveals another critical consideration. Transfer partners change frequently across the industry, and programs regularly modify transfer ratios or impose redemption restrictions. For business owners and executives who value time as their most precious resource, the complexity of monitoring multiple partner programs represents a hidden cost. If your time is worth 200 to 500 USD per hour, spending 10 hours annually optimizing point redemptions costs 2,000 to 5,000 USD in opportunity cost, potentially exceeding the entire annual rewards value. The cost of capital comparison is where institutional analysis separates from retail advice. If you have access to business credit lines at 4 to 6%, home equity lines at 5 to 7%, or margin accounts at 7 to 9%, you possess lower cost capital than most consumers. The relevant question becomes, what's the marginal value of adding another credit facility to your capital stack? For many business owners, adding complexity for modest rewards doesn't enhance financial efficiency. Now let's conduct an alternative value comparison. Many affluent individuals negotiate rent reductions for annual prepayment, often receiving 3 to 6% discounts. On 60,000 USD annually, a 4% prepayment discount saves 2,400 USD. Compare that to earning 60,000 Bilt points valued at approximately 780 to 1,200 USD at realistic redemption rates. The prepayment discount delivers 2 to 3 times more value, plus it's immediate, liquid savings rather than a liquid loyalty currency. Similarly, allocating that 5,000 USD monthly into short-term treasury bills or money market funds yielding 4 to 5% annually generates 2,400 to 3,000 USD in risk-free returns, again substantially exceeding potential rewards value. Let's address the risk mitigation framework. Loyalty currencies carry several underappreciated risks: program insolvency, unilateral devaluations, expiration policies, and redemption restrictions. These risks don't appear in promotional materials, but they're real. Numerous loyalty programs have devalued currencies by 20 to 40% through program changes. For high-net-worth individuals focused on wealth preservation, concentrating value in a liquid loyalty currencies represents avoidable risk when the potential upside is measured in hundreds of USD annually rather than tens of thousands. The utilization impact on borrowing affects future credit capacity. Mortgage underwriters, business lenders, and private banking relationships all evaluate your credit utilization when determining loan terms. If you're 6 months from applying for a commercial loan, running large rent payments through a credit card could cost you 25 to 50 basis points on a $1 million loan. 2,500 to 5,000 USD in additional interest costs over a 5-year term, far exceeding annual rewards value. From a tax efficiency comparison standpoint, the IRS generally doesn't tax credit card rewards earned through personal spending. However, if you're using a personal card for business expenses and deducting those expenses, the interaction becomes more complex. For business owners running rent for office space through personal cards and deducting home office rent as a business expense, rewards earned on that expense might technically reduce the deductible amount. Consulting qualified tax professionals about this interaction is prudent for anyone running substantial business expenses through personal cards. Let me present a strategic alternative framework. Instead of asking whether Bilt is worth it, ask, what's my optimal capital allocation strategy for housing expenses? You could negotiate prepayment discounts, allocate funds to short-term investments, structure housing through business entities if legitimately business-related, or prioritize simplicity and pay through direct bank transfer while focusing your optimization efforts on larger opportunities. For someone with a 10 million USD investment portfolio, spending hours optimizing 800 to 1,200 USD in annual credit card rewards represents poor time allocation. Your optimization focus should be on asset allocation, tax efficiency, estate planning, and investment management, areas where decisions affect hundreds of thousands or millions. The long-term value projection reveals systematic devaluation risk. If you're earning 5,000 points monthly, it takes 12 months to accumulate 60,000 points. During that accumulation period, the program could change terms, reducing your redemption options or value without recourse. This is particularly relevant for individuals who accumulate points slowly through rent alone rather than through heavy travel spending. Before we end, let me summarize these 4 critical insights. First, the true cost of rewards programs is opportunity cost. Every dollar earning 1 point worth 1 to 2 cents could potentially earn 4 to 8% annually in alternative investments, creating a 5 to 10 times return differential over time. Second, credit utilization affects your entire financial architecture. Running large recurring charges through personal credit can constrain your credit capacity for higher value financing opportunities, potentially costing thousands in higher interest rates on future loans. Third, liquidity has measurable value for high net worth individuals. Converting cash into a liquid loyalty currency eliminates flexibility to capitalize on investment opportunities or manage unexpected needs. Fourth, time allocation matters substantially. Hours spent optimizing modest rewards represent opportunity cost far exceeding the potential benefit when your time is better allocated to decisions affecting larger capital amounts. Here's my verdict and final analysis. The Bilt card is worth it for a narrow audience. Individuals with substantial rent expenses, limited investment alternatives, and time to optimize redemptions. If you're paying 4,000 to 8,000 USD monthly in rent and lack access to low-cost investment opportunities or prepayment discounts, the card can generate 800 to 1,800 USD in annual value. However, for high-net-worth individuals with sophisticated capital access and diversified investment portfolios, the card delivers minimal value relative to alternatives. Your capital is better deployed in tax-efficient investments, your credit capacity better preserved for strategic financing, and your time better allocated to decisions affecting larger amounts. The card isn't bad, it's simply optimized for a different audience than sophisticated investors focused on overall capital efficiency. Subscribe for institutional-grade analysis that examines financial decisions through the lens of total capital efficiency. Like this video if it changed your perspective on evaluating rewards programs within your broader wealth strategy. Comment with questions about how these concepts apply to your specific financial architecture. I am not your financial advisor. This content is for educational purposes only. Consult with qualified professionals, including tax advisors, wealth managers, and legal counsel, before making financial decisions. Past performance and historical program terms don't guarantee future results.